where we take the financial analysis and raw data you provide and turn it into clear, targeted knowledge. For this dive, you've sent us a really fascinating report on TLRY brands, and it's all focused on that one major headline we've been seeing everywhere: record revenue and positive EPS.
Yeah, that headline is doing a lot of heavy lifting, and it's why this analysis is so critical right now. We are zeroing in on the results from Q1 fiscal year 2026. So that's what was reported back in October 2025.
Okay.
And this wasn't just, a good quarter. This period really marked a major fundamental inflection point for the company.
And when you look at the sector TLRY operates in, it's a sector defined by just massive regulatory risk and huge upfront investments.
Right.
So achieving positive net income is more than just a win. It feels like a historic validation.
It absolutely is. It suggests that their aggressive multi-year diversification strategy has, finally clicked.
It's finally working.
It is. But the market is still sort of processing what it means. We
Yeah.
see that reflected in the stock price. As we're talking, it's trading at $9.03.
Right on top of a key support level.
Sitting right atop a critical support level.
Yeah.
And you have to remember the history here. Late 2025 it was a period of extreme volatility. The price shot up to a blistering high of $23.20.
That swing from about $3.50 up to $23 and now back down to $9, that's enough to give any investor whiplash.
It really is. And the sentiment reflects that. It's leaning bullish because of these Q1 results. But there's a profound sense of, let's call it, cautious optimism. Everyone is just waiting for the next major news, specifically that Q2 earnings release, which is coming up on January 8, 2026.
So we're in a holding pattern.
A serious holding pattern. Okay, let's unpack this.
All right, let's start right at that inflection point.
Right.
What were the specific financial achievements in Q1 that let them, definitively change the narrative from cash burning growth story to something sustainable?
There are two numbers that just stand out above everything else. First, the top line success. Record revenue.
Okay.
They hit $210 million, which is a record for a first quarter performance, and it's up about 5% year over year. So that's stable, good growth at the top.
But, as you said, the top line doesn't mean much if you're just lighting cash on fire to get it. The real story here has to be the bottom line.
Precisely. The second number is the net income swing. They achieved a positive net income of $1.5 million.
Wow.
Now, to really appreciate this, you have to look back. In the same quarter, just the previous year, they reported a really painful net loss of $34.7 million.
$34.7 million.
To reverse a loss of that magnitude and actually push into the black is incredibly difficult from an operations standpoint. That $36 million turnaround, that is the turning point investors were waiting for.
That distinction is so crucial. For you, the listener who looks at their investment statements, this profit translates directly into the earnings per share. The report shows EPS was basically positive or break-even, right? Somewhere between 0 and 1 cent.
That's right.
I understand analysts had expected a pretty significant loss, didn't they?
They did, yeah. This number completely surpassed analyst expectations, which were forecasting a deficit. And beyond those headlines, the supporting metrics, they really validate the sustainability of this.
Okay.
Adjusted EBITDA, which is, a proxy for core business health, was $10.2 million. That's up 9% year over year.
Wait, let's pause there on efficiency, because sometimes a profit figure can hide operational issues, but the analysis points to a massive improvement in cash management.
It does. And this is the piece of the puzzle that's often overlooked, but it shows true operational discipline. Free cash flow saw a major improvement.
How so?
The company reduced its cash burn by about $34 million compared to the year before. What's fascinating here is that all the metrics point in the same direction.
Stability and efficiency.
Exactly. They are improving dramatically. That reduction in cash burn means they are lighting substantially less cash on fire every month. It gives them a much longer financial runway, more flexibility for whatever comes next, even if regulatory changes take years.
Okay, so we've established the pivot happened. The numbers suggest it's sustainable. But hitting these milestones wasn't an accident. It forces us to ask, how? What was the strategy that finally delivered that revenue?
This is where the brilliance of their diversification strategy really shines. The analysis clearly points to two specific segments that drove this performance: U.S. alcohol and international cannabis.
Two parallel businesses.
Essentially, yes. And they have complementary financial goals.
Let's start with the U.S. alcohol expansion, because that seems to be the bedrock of this new stability.
That's exactly the right word for it. The alcohol division provides the financial ballast. TLRY is now the 5th largest craft brewer in the U.S.
The 5th largest.
They didn't just dabble, they went all in. They acquired and integrated these powerhouse brands like Shock Top, Breckenridge, and Montauk.
But is being the fifth largest craft brewer actually a good thing? I mean, is it a sign they're over-leveraged in what is a very saturated market? Is that cash flow really as stable as we think?
That's a crucial question. And the analysis argues that while the market is saturated, these are mature brands. They have very predictable consumption patterns.
So it's not about explosive growth.
Not at all. The strategic role here isn't growth, it's stable, predictable cash flow. It's essentially financing the future of the company, de-risking the entire operation while they wait, patiently or impatiently, for U.S. cannabis legalization.
So you've got stability from beer, and then you have this high-octane growth from the second engine, international cannabis.
Correct. The international cannabis division is surging. And nowhere is that more obvious than in Germany,
where Tilray is a dominant market leader.
A huge market leader. And that ties directly into the external forces, the geopolitical catalyst that proved their international strategy was ready.
Ah, okay.
If we connect this to the bigger picture, the German market provided the perfect boost. Medical sales surged after cannabis was descheduled in Germany. That was back in April 2024.
And that regulatory shift just instantly expanded their market.
Instantly.
Yeah.
And it directly benefited their existing robust infrastructure there.
Yeah.
The combination is just powerful. Stable domestic cash flow, subsidizing high-growth international expansion.
All right, let's pivot now. Let's go from the internal strategy to the external market forces, because those factors have absolutely dictated the drama in the stock price recently. Let's talk about that volatility, the Trump bump.
That late 2025 period was just pure frenzy. The massive rally that pushed the stock up to that staggering 2320 high that wasn't driven by Q1 earnings.
Not at all.
It was entirely driven by market reports about a potential executive order to reclassify cannabis to Schedule III in the U.S.
And for you listening, we should probably clarify why Schedule III is such a monumental change, because that policy news is what created all this volatility in the first place.
Right. The core benefit of moving cannabis to Schedule III away from Schedule I is the potential elimination of this crippling U.S. tax code known as 280E.
280E, right.
This code currently prevents cannabis companies from deducting normal business expenses. Their effective tax rate is astronomically high, sometimes over 70%.
So eliminating 280E would just, flip a switch on the entire U.S. sector overnight?
It would instantly unlock massive domestic profitability. Yes, just like flipping a switch.
So the market rallied on that expectation, but the price has since pulled way back. The current $9 price, that's a serious cooling off period, right? The market bought the rumor and is now just waiting for the final details.
Exactly. It's a textbook case of consolidation. The market is holding its breath, waiting for the final details of that Schedule III policy before it commits to the next big move.
So what does the snapshot look like now?
Current price is $9.03. The 52-week range is that insane $351 to $23.20. It just shows you the scale of the speculation.
Right.
And there's one technical factor here that keeps things exceptionally volatile.
And here's where it gets really interesting. The volatility isn't just about policy.
No, it's about positioning.
Right.
Short interest is high. Approximately 15% of the outstanding shares are being bet against the company.
So a big chunk of the market thinks the price will fall further.
They do. But if a major positive catalyst were to happen, like the finalized Schedule III rule, all those bears would have to rush to cover their positions. It keeps the potential for a massive short squeeze alive and well.
Which moves us squarely into the technical view and what's coming up next. For the listener looking forward, all eyes are focused on one immediate date.
January 8, 2026. The Q2 earnings release.
Right.
The market needs to see if Q1 was the start of a trend or just a one-off.
And what are analysts expecting for that report?
Consensus revenue is expected to be solid, around $211 million, so right in line with Q1. However, analysts are expecting a slight seasonal dip on profitability.
A loss.
They're forecasting a consensus EPS at a loss of 14 cents. But the important thing to stress here is that the bar is set very low.
So a beat could really move the needle.
Oh, absolutely. If they manage to beat that forecast, even just hitting break even again, that could be the confirmation needed to ignite the stock back into the double digits.
And technically speaking, the price action looks pretty familiar. The analysis report notes the stock is tracing out a bull flag consolidation pattern.
That's right. That $23 move was the flagpole, and this retreat back down to $9 is the flag itself. It shows the price is just resting, gathering energy at a key support level.
And the analysis details those critical levels to watch, right?
It does. Support is very tightly clustered between $80 and $9. That zone is explicitly described in the report as the critical buy the dip zone. It's where the institutions are signaling entry.
Okay, so that's the floor. What's the immediate hurdle they need to clear to confirm that this consolidation period is over?
Resistance is sitting right at $10.77, and that aligns perfectly with the 50-day moving average.
I see.
The outlook is pretty clear. A decisive break above $11 could trigger the next leg up, pushing the price towards 15 and confirming this short-term retreat is finished.
So stepping back, looking at the long term, what does the official analyst community think now that TLRY has proven they can actually generate net income?
Analyst ratings consensus is currently a hold, which indicates, neutrality in the short term. However, the average price target is a striking $20.
$20, that's huge.
That number is massive. It implies over 100% upside from the current $9 price. It just shows how much faith or risk is baked into that regulatory change. You're essentially betting on policy in Washington, D.C., not just the balance sheet.
And that's really the crux of this deep dive, isn't it? The core business fundamentals have shifted drastically. They're profitable, they have cash flow stability. But the huge upside remains completely tethered to the eventual implementation of Schedule 3.
That's the summary. To recap the most significant points, the company successfully executed a pivot to profitability in Q1. They did it through diversification, using stable alcohol cash flow to fund international cannabis growth. Their business model is working. But the current valuation remains highly reactive to those looming U.S. regulatory changes.
So what does this all mean? This deep dive shows a fundamental shift. The company has transitioned from a purely speculative growth story to one with a real foundation. But as long as that $20 price target is out there, its valuation is still heavily tied to speculative policy changes. It's a high-conviction, high-volatility play.
And that leads to a final provocative thought for you to consider. Analysts are currently expecting a seasonal dip, right? They're projecting a loss of 14 cents for Q2 EPS.
Right, the bar is low.
So, if the company manages to repeat a positive net income on January 8th, despite those low expectations, what would that signal about the true long-term stability of the alcohol cash flows? Does it mean the business is performing far better and providing even more insulation than the market is currently giving it credit for?
A great question to take away as you analyze your next moves.